time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Aritzia, symbol is ATZ on the TSX, $42.67, about a $4.7 billion market cap. Clients will know Aritzia well. It was recommended to our Canadian growth stock clients in January of 2019 at around $16.80. Since then, in a tough retail market for retail stocks, it's been up 154%. So the company was founded in 1984. It's a long-term growth-oriented, innovative design house and fashion retailer, exclusive brands targeted to women primarily in the ages of 15 to 45. The company is positioned between affordable luxury and fast fashion, and its loyal customer base cites design, the quality of the fabrics, the construction of Aritzia's offerings as key differentiators for the business. They operate over 100 stores across Canada and into the US, in addition to a robust, established e-commerce platform. Okay, so let's look at recent financials. The Q3 revenues came in at $624 million. That's up 37%. Adjusted EBITDA at $119.6 million, up 9.5%. And adjusted EPS up to 67 cents per share, up from 61 cents, around 9.8% gain there. Our conclusion here on the company, both during and subsequent to the pandemic shutdown, Aritzia consistently and considerably has outperformed most North American retail peers. It saw its share price jump to the mid $50 range at one point before pulling back to its recent range after the Q3 results. What we saw in the Q3 results that had the share price pull back, an elevated inventory position, modest lowering of fiscal year 2023 guidance, and the lowering of consensus estimates that had a negative impact on the share price in the near term. We recently updated it when it was trading in the $48 range, said it was close to fair value and maintained our hold in the near term. We like it long term. Stock's now in the $42.50 range. There is a cautionary note as well. I would point out that inventories are greater than 500 million right now as at Q3. That is up 187% year over year. This was partially due to management strategy to satisfy ongoing demand by increasing order lead times. However, the supply chain has been all gummed up for a company like this. As these are easing, this led to spring and summer merchandise arriving early as well, so that boosted inventory. The resulting stress on the company's distribution centers caused cost inefficiencies in the quarter that should persist likely into the first half of 2024. That's the company's fiscal 2024, which is just entering. As such, and while we continue to expect demand to exceed peer comparables heading into a potential recession, we remain cautious on the stock in the near term. If we look at annual estimates out there for this year would have the company in its range right now, trading about 23.4 times adjusted earnings. Expected growth next year would bring it to the range of right now trading at around just under 20 times next year's or fiscal 2024 earnings. Long term, in a tough space, Aritzia is likely positioned to produce above average top and bottom line growth. The market is forecasting, or analysts are forecasting, 15% compound annual growth rate over the next several years, driven by organic expansion and relocation of stores, as well as increasing its e-commerce penetration. So over the long term, if you're looking 3 to 5 years out, we like this business. In the near term, it's probably been closer, but particularly like we said, in the $48 range to fair value.
Awesome.
Yeah, and there's not many retail stocks that we really love, but there's a few that will stand out. That and
Yeah.
one of the things that obviously we want to see is a strong e-commerce component, but also it's I think somewhat of a niche. And I mean, Aritzia a lot more than me, Ryan. But I mean, it's not just, it's not like, investing in the Bay, right? It would be more of a niche retailer. Maybe that's not the best way to describe it, but special.
Yeah. I mean, yeah, for sure. Specialized and really,
focusing on what they do best, right?
Mhm.
For women's fashion, that 15 to 45 range, and just knocking it out of the park. Very responsive to customers, and carefully expanding over time. There's been a call for them to expand faster and faster and faster, which some other Canadian retailers have done that in the US and got clipped, right? Like got hit really hard because they didn't do it effectively. But I mean, this company has never, they go into an area, they put in a store, and they've never closed a store. So you're doing that with careful thought and consideration to the market you're going in, which is what you'd like to see rather than consistently. Like one thing I always look at when I see a retail stock is there's usually a line item that says how many stores we opened this year, and then there's always how many stores you close. So you got a net store openings in a year to try to get growth. Well, Aritzia basically just has the line where it's net openings, right? Because they're not really closing. So I mean, it's lovely to follow. It's easier to look at, and when they go into a store, they're maybe refurbishing it or moving it across the street if they'd ever done that, but it's in the same locale, right? So they're not really closing down locations because they're carefully thinking, where do we want to go? Is this going to be profitable? And it's been a really great Canadian success story that's kind of flown under the radar. But now I do remember back when we originally looked at it, we were looking at it and Canada Goose.
Mm-hmm.
And Canada Goose at the time was trading at significantly higher multiples and basically had a ton of analyst coverage, saying, this is the greatest company ever, basically. And the thing was, it was the one product, really, the parka for me that, in fashion, if something goes out of fashion, I'm not saying that parka has gone out of fashion or out of style or anything like that, but it can really get hit hard if that turns on you. Whereas Aritzia has several different brands. They can shift from one brand to the other. And also, their valuations when we originally recommended it, very reasonable relative to Canada Goose. Now, Canada Goose has had significant challenges over that period. Aritzia, not so much, done very well where Canada Goose hasn't. So we're happy we made the call to go with Aritzia over Canada Goose. And the balance sheets are, I would say in Aritzia's favor right now, those two as well. And just the more consistent growth and the more broad product line from the company that, is not as much of a one-trick pony. So the other thing is every time I go in there, my wallet gets lighter. So that's just anecdotally. Go into an Aritzia and they are busy, which is a good thing to see. So to bring it back to Peter Lynch, he likes you to go in and actually touch and feel the investments that you're looking at. And sometimes you can do that. In the case of Aritzia, you can, if you're somewhere in Canada, you can likely go into a store and see if you like what's going on in there. And usually they're busy in malls where they're not always busy, which is a good sign.
Yeah, I remember when we were comparing it to. Sorry, if I just could.
Yeah, no.
Bit. And my one friend, Rylan, who you guys hear me talk about, he was considering buying Canada Goose, and I told him about Aritzia and how they've never closed the store and whatnot, and he did end up avoiding it, and I believe that was around that was in 2021, and we've literally seen the stock get cut in half basically from where it was trading at around $52. Canada Goose. Yeah. Yes. And the thing about Canada Goose too, very seasonal business. I believe their January, whenever they post in January, is their biggest quarter. Very seasonal business. It's nice to have consistent business with a company like Aritzia. And I know another friend of mine, his fiance's sister, loves Aritzia. She actually. She's an equity analyst for a PE company in Saskatchewan, but she still keeps her part-time job at Aritzia just so she can get those deals. So it's definitely popular among the women category 15 to, what did you say, 46, 56?
15 to 45. 46, you're not allowed to shop in there. Sorry, it's over.
Anyways,
they won't let you.
Yeah.
I know, it's true. No, it's well run, which is nice to see. It's a Canadian success story. It actually started in Vancouver, so it's been a good business for sure. And we continue to think in that sector. It's not cheap, but it's for a reason that it trades at good valuations, premium valuations, but it offers a decent price.